So let's talk about index universal life as an asset class. Now again, of course, all the values we show are always based on the client's objectives and assumptions. Over time, results are going to be different than what you see. And you've always got to look at the complete illustration from the insurance company for all guarantees, assumptions, and disclaimers. Now, I'm a client and I've got money in fixed income, bonds, if you will, and equities. So let's suppose that in my portfolio that is 20% bonds and 80% equities. Let's suppose in bonds, investment grade bonds, I can get 3% interest, and I'm in New York and California in this example, so it's getting taxed at about 53%. Of the 80% that's invested in equities, I'm going to assume that I can get 6.45, and that's going to be taxed all in federal and state capital gains, 34%. That would actually generate a 4% after-tax return, not even taking into account any investment expense. The money that I would put into the bond and stocks, let's say I take it out and I put it inside an indexed universal life policy with 20% to the fixed account, which is essentially a fixed income alternative in a universal life policy, and 80% to the S&P indexed account. Currently, Pacific Life is crediting 4.2% in mid-January. I'm using a Pacific Life illustration, and I'm going to assume that I can get a 4.6% S&P that would credit 6.45 under a one-year high par. Growth of the S&P times 150%, getting me a 6.5% credit on 80% of the money. So if I had $1 million and 20% was in fixed income or $200,000, getting this rate of return, the bottom line of the gross rate of return in taxes, it would generate about 4% interest. Now, secondly, if I took $1 million and reallocated it over a 5-year period of time, in other words, $200,000 a year, I'm going to put into stocks and bonds, netting 4% after tax and investment expense. Let's just assume that was the number, 4%. But when I put $200,000 in after tax, I'd get $8,000. So now at the end of the first year, my $200 is worth $208. Now, if I did this for a 5-year period of time, $200,000 a year for 5 years, that means that I allocated $1 million to stocks and bonds right here. At 65, I was a 50-year-old when I did this, by the way, age 50. I would then project an accumulation of $1.7 million. Now at that point, I'm going to sell off stocks and bonds, $175,000 a year from 66. Now I can get it through age 77. But unfortunately, at 78, I only have $42,000 left. So the total tax-free income, $2.1 million selling off the stocks and bonds, assuming a 4% return. By the way, at age 78, all of this money is gone. So to summarize, $1 million went in, $2.1 million came out, and at age 78, I have nothing left. We break this out into two parts. The accumulation phase, which is the period of time up until I take out income, and the distribution phase, which is the part that people don't pay attention to. The beauty of Index Universal Life is how it is built, if the policy is properly structured, to generate substantial tax-free income with a lower volatility quotient, if you will. Now, if I took that same $200,000, put it in the Index Universal Life policy with Pac Life the way we built it, allocated the way we said, at the end of the first year, I'd only have $112,000 of cash, more than 50% of what I put in, plus a death benefit of $3.7 million. Don't get the death benefit in the stocks and bonds, but that might not be important to the client until he's basically diagnosed with some terminal disease. I never knew somebody that had too much insurance when they were told they had 1 year to live. Taking the same $200,000 a year for 5 years that we would have put in stocks and bonds, totaling that $1 million, putting it into the policy under the assumptions that I went through before, I would accumulate more at age 65 than the stocks and bonds. 1.8 million would be the projected balance. That would allow me to take out $175,000 a year from age 66 all the way down to 85. That's a total of $2.6 million of tax-free income. That is the equivalent of taking out $372,000 from an IRA 401k plan and basically $5.6 million coming out of an IRA, right? Depending on your tax bracket assumptions. But in my IUL, when I'm done taking out that $2.6 million, I still have $500,000 of cash and a $600,000 death benefit. Might want to use that for long-term care. So now let's juxtapose the possibilities. I told you if I took $200,000, put it in bonds and stocks, got 4%, it would be worth $208 at the end of the first year versus $112,000 in the policy. So if your only focus is myopic, what is it worth short term, you would never allow a client to do this. But putting in the same amount into each financial gladiator, just to remind everybody, there's the $200,000 a year for 5 years, $1 million. In the mix of bonds and stocks, $1.7 million at the end of the accumulation phase, age 65, versus $1.8. But the IUL is so much more cost effective, even taking into account costs. What happens when I sell the stocks and bonds, you'll remember I can take out $2.1 million, but at age 78, everything is gone. When I take the $175 out of the policy, when I run out of money with stocks and bonds, I still have $740,000 left, allowing me to take out 4 more years of $175,000 a year for me. Same money in, but what did I get out? $2.6 million for me versus, but by the way, I've got a bunch of money left over. And that's for the same $1 million investment. And the death benefit if I die at age 90, an additional $900,000 that I don't get with the alternative. So when I look at the total amount of tax-free income for me, plus the death benefit at 90, $3.6 million, versus $2.1 million from the mix of stocks and bonds, ladies and gentlemen, that's a $1.4 million advantage. And by the way, no sleepless nights. Now on this particular page, this illustration, if we put the same $1 million into the bonds and stocks as the index universal life policy, if I was able to take out the same tax-free income for the same period of time, totaling $2.6 million from the stocks and bonds as I was taking from the policy, and if at death, at 90, I would have $900,000 left over at the stocks and bonds to match the policy death benefit, I would have to net 5.44% after tax and investment expense to match the income flow and death benefit from the indexed universal life insurance policy. And again, no sleepless nights. If I get unlucky and I get sick early, having the millions of dollars of death benefit is obviously a considerable benefit. So Mr. Client, if you could capture between 9 and 11% of all the up markets only, if down markets didn't affect you, if you could lock in the gains guaranteed by Pacific Life, one of the oldest and largest insurance companies in the United States, if the IRS said it all grew tax deferred under Section 72E1, if the money came out tax-free under Section 72E5C, and if you had ready access to that cash, if you could have all of that, what percentage of your low to moderate risk portfolio and your annual savings would you allocate to such an asset class? And I think the answer is 100%.